50% surge in a cryptocurrency token over 24 hours is not unusual in this market. But when that token has been quietly operating behind the scenes for 5 years on one of the most volatile blockchains, and suddenly explodes in value not from hype, but from real, measurable usage, it demands a closer look. That's exactly what's happening with Stream, the native token of Streamflow Finance, and the driving force behind this momentum is not speculation, it's Stream staking. What makes this different from the usual pump cycles is that the yield isn't manufactured through inflationary emissions. It's funded by actual revenue from a protocol that's been live since 2021, processing real transactions for over 40,000 projects and 1.3 million users. This isn't a flash-in-the-pan DeFi experiment. It's a mature platform finally getting the attention its fundamentals deserve. The numbers are now impossible to ignore. Stream spiked 50% in a single day, drawing fresh interest from traders across the US, UK, and Southeast Asia, particularly in Indonesia, where yield-focused crypto strategies are gaining real traction. Trading volume surged, with Bybit reporting $242,000 in 24-hour volume at peak activity. Most people arrive after the move is obvious and the easy upside is gone. We focus on serious crypto education and high-quality signals before the crowd rushes in, so you can understand the setup earlier and move sooner. If you want that edge, visit the link below now. But the real story isn't just the price action, it's the mechanism fueling it. Streamflow runs a system called Active Staking Rewards, or ASR, where every fee collected from token vesting, airdrops, payroll distribution, and token locks flows directly back into the ecosystem. These fees are used for hourly buybacks of Stream, which are then distributed to stakers. That's what's powering the current 45.12% APY, a rolling 30-day average with weekly compounding. This isn't theoretical yield. It's revenue-backed, real-time income generated by real usage on the protocol. The importance of this model can't be overstated. In an era where most high-yield staking platforms rely on endless token printing to lure investors, Streamflow's approach flips the script. There's no inflationary dilution propping up returns. Instead, growth in user adoption and project integration directly increases the fee pool, which in turn increases buybacks and staking rewards. More projects using Streamflow's no-code tools for token distribution means more fees, which means higher yields for stakers. It's a flywheel built on utility, not promises. And because the platform is listed in Solana's official documentation as a recommended tool for token vesting, it's not just another third-party service. It's part of the ecosystem's infrastructure. Still, there are questions. Can this level of APY be sustained as more capital flows in? High APY staking is attractive, but if demand for staking outpaces fee generation, the rewards could compress. The model only works if protocol usage continues to grow at a pace that matches or exceeds staking demand. And while the current 45% APY is backed by real revenue, future yields depend on continued adoption. There's also the risk of centralization. Though the protocol is decentralized in design, the influence of early backers and large stakers could shape governance outcomes in ways that don't always align with smaller participants. Most people arrive after the move is obvious and the easy upside is gone. We focus on serious crypto education and high-quality signals before the crowd rushes in, so you can understand the setup earlier and move sooner. If you want that edge, visit the link below now. The broader signal here is clear. Markets are starting to reward longevity and real usage. While other tokens rise and fall on social media buzz, Streamflow's surge suggests a shift toward protocols with audited code, consistent development, and actual customers. The renewed interest from Southeast Asian DeFi communities, amplified by regional media coverage, shows that this isn't just a Western investor trend. It's a global recognition of sustainable value. The next signal to watch isn't price, it's protocol revenue. If fee generation continues to climb in line with user growth, the case for Stream staking strengthens. If not, the APY will adjust, and so will the market's enthusiasm. For now, the surge in Stream is less about speculation and more about a long-standing protocol finally getting its due. The real story isn't the 50% jump. It's that after 5 years of building, Streamflow is proving that real utility can still drive real returns in a market that often forgets the difference.